Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have John Maier. He's a Chief Investment Officer over at Global X. We're going to discuss using covered call strategies via an ETF to help generate some income. John, it is great to have you back in studio with us. Welcome back.
Thanks for having me back.
And before we get into the strategy itself, let's talk about interest rates and what your thoughts are around the macro environment as they continue to rise.
They are rising, and the Fed has been pretty explicit that they're going to fight inflation. So I would expect at the September FOMC meeting that rates will rise another 75 basis points. But overall, interest rates are still historically low. So if you look at a savings rate, you're still roughly 1.5% to 2%, if you're lucky on the 2% side. So investors have a great need for income, and despite rising rates, there still needs to be an alternative versus these very low rates.
So how can an income-oriented investor potentially derive more income to boost the yield in their portfolio?
Well, the simple answer is take more duration. But with more duration comes more risk. And we know that rates are rising. The Fed has been pretty explicit about that. So likely your bond values are going to go down. So you could buy high yields, you could buy emerging market debt, but again, that is more risky. So where we're recommending for investors to look at are MLPs, higher yields, REITs, preferreds, as well as covered calls. Covered calls are an interesting area and provides a pretty good income for investors looking for yield.
Why is the Nasdaq 100 a popular index to write covered call strategies against?
Sure, that's a good question. And when you think about covered call strategies, whether they be on the Nasdaq 100 or the S&P 500 or other indexes, if you want to get the highest possible yield, you're going to look for stocks that have higher volatility. So the Nasdaq 100 have a higher proportion of technology stocks. Technology stocks are typically a bit more volatile, and thus you're going to get a higher option premium received by writing options on the Nasdaq 100. So that's why you're going to get a higher premium, higher income by buying a covered call fund based on the Nasdaq.
Which market situations are best for covered call strategies?
When you think about covered call strategies, you think about, how am I getting this income and what am I giving up? So now you're giving up your upside. So if you think that particular index, the Nasdaq, is going to go up 30%, but you're getting a 12% income, that you likely wouldn't want to buy a covered call strategy. Now, if you think that the market is going to be more range bound, that's an environment, or a flat environment, that's an environment that you would like to you'd be most interested in a covered call strategy, more of a range bound flat market.
All right, John, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.